Hi guys, and welcome back from the break. I hope you got a chance to grab a sandwich and a drink. We've got another great panel for you coming up, but just a quick note on something else that came up from the previous panel about sort of engagement and mentoring and mentees. I think there is a clear gap here with the COVID crisis where we've got younger people coming through the industry that are wanting to be able to have that mentorship. Within Fix, we are setting up a mentor scheme. If you are one of those mentees who are looking, or potential mentees who are looking for that, we have a list of senior people within the industry who have actively put themselves down to act as mentors. If you're interested, please go to the Fix booth, and there is a form there which you can fill in, and we'll try and align and match that up so we can get better engagement there. Now, just to introduce the next panel, we have the panel based on the evaluation of liquidity, performance, and service in equities. It's being moderated by Vernita Exum, who's head of equities for Europe at Vanguard. And to introduce this panel, we've got Rob Boardman, who's CEO of Virtu Europe.
Good afternoon and welcome everyone. I'm Rob Boardman from Virtu Financial, and it's my pleasure to introduce the Fix EMEA stream session today, where we'll consider how to evaluate liquidity, performance and service provided to institutional investors. The background to this debate has been set this year by several different factors. Firstly, the exceptional volatility in volumes in March and April, followed by a period of calmer markets over the summer months. A surge in the relative importance of retail investor flows has also contributed to a changed liquidity landscape for global equities. These factors have left many institutional investors and their brokers having to recalibrate their models, tools and trading styles. Perhaps equally important going forward are the consultations and policy recommendations from ESMA and other regulators. They have the potential to change the landscape in areas such as dark liquidity and other innovations such as frequent batch auctions. Over the years, most of the surveys of institutional traders have cited liquidity as one of the most important features provided by brokers and venues. Whilst that's undoubtedly still true, recently we've seen many leading asset managers adopt more systematic trading styles tuned by a new generation of quantitative analysts using advanced transaction cost analytics and execution management systems. So now institutional investors have the tools to ask much more subtle questions of their providers, in particular about the quality and not just the quantity of the liquidity that they consume. Another trend in recent years is that institutional traders have deepened their execution relationships with fewer providers, allowing their traders to become experts in the execution tools they use. This has had the knock-on effect of increasing their economic importance to each of their partner brokers, who need to respond with stronger service levels to support their clients and reduce operational risk. Our aim in this debate is to help institutional investors decide how to pull together all these threads to produce a best-in-class trading platform to serve their end investors. With the challenge set, let's hand over to the panel. Thank you.
Good afternoon, everyone, and welcome. I'm Vernita Exum, Head of Equities Europe at Vanguard Asset Management. So today we'll start with a short postmortem of the pandemic-related period of volatility that we experienced earlier this year, and then shift our discussion towards Brexit share trading obligation concerns. And lastly, we will allow you, the audience, to select 2 regulatory or industry-related topics to be discussed by responding to our polling question. For this panel, we have such a breadth of representation across our ecosystem, regulators, exchanges, brokers represented, so expecting a lively discussion. But first, I'd like to ask each of our panelists to quickly introduce themselves. Panelists?
Hi, I'm Séverine Vandelanoite. I'm part of the products and regulation team at Deutsche Börse Cash Markets, so stock exchange.
Hi, I'm Chris Jackson, Head of Equities and Equity Strategy in Europe at Liquidnet.
Hi, I'm Tom Stenhouse. I'm Head of Product for LSE Secondary Markets and Turquoise.
Oliver Chapman, Director in Execution Sales at Barclays, background in product, here for the last 12 years as well.
Thank you very much. So now before starting our first segment of discussion, I want to toss out our first polling question, and that'll provide you some time to register and get ready for the subsequent questions. So here it is. How prepared is your organization for the next significant liquidity-related market shock? And we will have the responses for this question after segment one. Now, first topic, COVID-19 pandemic. What an eventful time for us last spring, and potentially more to come as this global health crisis is not quite over. So let's take a few minutes to discuss what we've learned. And let's start with the big picture. Chris and Oliver Chapman, from a liquidity standpoint, how is this market regime different from the global crisis? And what aspects of market structure have changed since the GFC to help or hurt our market resilience?
Shall I kick off on that? Yeah, I mean, and on the face of it, a lot of similarities with the global financial crisis. When you look at some of the key metrics around how markets performed, very high volumes, extremely high volatility, and broadly across the market, this was reflective of a huge amount of uncertainty. But if you look a little closer, I think the impact and the two situations, the two sets of market circumstances were markedly different. And firstly, in terms of market structure, and secondly, in terms of just the level of confidence across the market. If you look in terms of market structure, I think the environment that we inhabit now is a significantly more secure one at the exchange and trading level. The trading halts regime that we operate in this environment, as opposed to 2009, is vastly different. And if you look into the brokerages and various participants in the market, the level of oversight and control at the electronic trading level has really increased, partly driven by increased regulation in that space, but also driven by a general improvement in technology. So as we went into the March volatility, we were in a position to trade over 1.2 million transactions a day, and this was something that I don't think would have been thought as feasible 10 years or so ago. The other point, though, is confidence, and I think this is where the market conditions were markedly different. In 2009, there was no confidence in the market. You were trading the majority of business with bulge brackets who were going out of business or being nationalized. Confidence in execution at the equity level with prime brokers or with freestanding FX contracts simply wasn't there. Trades that were not collateralized were often not settling. So that simply wasn't an environment that we saw in March. The confidence in the system, I think, was extremely high, and the counterparties operating there. So I think, in that sense, very different.
I guess probably on top of that, I guess one thing which we look back between now and then is what we've actually seen also is a little bit of consolidation in the industry. I think probably the buy side is a little bit less diversified in terms of the number of active asset managers. And also, I guess, as you probably know, we've seen obviously the growth of passive management, and arguably you could say that that's a little bit less active in terms of the way it is traded. I'd say that probably if you take those two factors, what we do see a little bit here between now and then is therefore there's probably less participants in terms of the liquidity interactions that can occur. I think probably what we saw a little bit was some of the issues around liquidity here within this one. I think what we did see, though, was kind of the fantastic use of automation compared to what we saw in the past. If we think back to the last one, we'd just come through with MiFID I and fragmentation hadn't really occurred. We hadn't seen that automation of the blocks. For instance, CBOE LIF played through block discovery, which obviously we saw those upticks and therefore that access to liquidity people had. But we also saw the SI framework kicking in. And while we did actually see a decrease in market share from the SIs, a lot of the ELP ones, as we refer to them, did actually increase. They saw, for instance, about 40% uptick across the board. So there's two factors to that in terms of liquidity. There was that ease of it in terms of the automation. We did actually see it also that, and some of the market participants weren't necessarily there or trading different styles from before. So I guess that's probably the big thing that I'd pull out between now and then. And actually, Chris, I thought touched on a great point there. What we did see within the market between kind of the exchanges and actually also the participants, we didn't see issues with the exchanges going down with the volumes. We didn't see rogue algos going on. And I guess we do actually have to thank a little bit of the regulation for that in order to make sure that we are actually kind of going about things the right way. Although you could also make the argument that we should probably and would have found our way there anyway.
Thank you all for those foundational insights. As brokers, regulators, and exchanges, each of you have a significant role to play in contributing to market liquidity. So during the peak of the volatility, how do you think your segment of the ecosystem did overall? And please provide one or two things you did well and at least one thing you think that you could improve on. And I'll ask all of the panelists to respond, please.
So I might kick off on this one. So I indeed, as mentioned by Chris and Oliver earlier, I would consider that the whole ecosystem, as you named it, actually worked quite well. And I was thinking about these words that Chris used, the one of confidence. This is something indeed crucial. I mean, banks remained open, markets remained open. We did communicate on this rather early. And the same way that FESE, the Federation of European Exchanges, also did communicate. And I think indeed it is this confidence that we have sound and reliable systems that allowed market participants to keep on trading and not to withdraw from the markets. Obviously, these times were challenging. We had, looking back into March 2020, we had some days with peaks at 250 million messages a day, which is a lot more than what we have on average, but still we did not reach the maximum capacity of our system, so that's still good news. And we also reached at the peak, I think it was on the 12th of March, we had 3.5 million orders executed on our platform, which is 5 times the number of the average number of orders executed if you look at 2019. So that's quite a significant increase. Obviously, that means also in our case, that there was not just an increase in the activity, but because of the high volatility, there was more need for immediacy, immediate liquidity, and hence we also had at the same time an increase into the market share of lit regulated markets. But that was rather well handled, and obviously we had tools for this, as mentioned as well. We do not have the circuit breakers the way they are set up in the US. So it's not because our main indices become too volatile that we shut down the market. We can always close some segments on the market, but these are discretionary decisions anyway, not based on threshold calculations. However, we have these volatility interruption systems, etc., which are actually the ones defined as trading interruptions by ESMA. And yes, these ones, we've been using them intensively. If you look at our DAX index, we had 10 times more volatility interruptions in the first half of March 2020 compared to March 2019. And it was even more pronounced for ETFs when this time it was 35 times more volatility interruptions. But that worked well at the end because thanks to this, we were able to keep our markets open and tried, although we all know that spreads have widened, we also tried to keep liquidity provision as high, I would say, as possible by also supporting our market makers through our designated sponsor programs, where we did allow for widening of the requirements in terms of quotes. And for example, our liquidity provision program on DAX and MDAX, we also increased, we actually doubled the requirements in terms of presence at the BBO, and to show that it's a process where we are also learning. Actually, this measure has now become part of the contract of the liquidity provision program. So this one was drawn actually in 2017 when we did not really have very high volatility. But now that you've experienced this episode in February, March, we've actually added a clause in our contract of the LPP where when there is the volatility is too high on the indices, so 3%, then we will allow for widening the requirements for our liquidity providers. So this is something we are learning with this situation, definitely. And very briefly regarding things I think could be improved, the short selling ban, I think, is the problem, was a problem. We did not have it in Germany, but it was implemented by 6 countries in the EU. The reasons why they were implemented can be understood. Because it's in order to protect the market, to prevent to have extreme price movements, for example. However, I mean, academic research shows that actually short selling bans do have actually negative impact in terms of liquidity, in terms of price formation. That any short selling ban that was put in place in 2008 or in 2011 actually did not have the positive impact they were supposed to. And from our first observations, we actually could see that short selling bans actually had indeed a negative impact in terms of market activity or price formation, in terms of update of quotes on the markets concerned. So I think there's really a need to look into this measure. It's not a light one. It can have detrimental effect on liquidity, and a decision on an EU level, I think, would probably be welcome in case there is another crisis of the same extent.
Thanks, Séverine. Just very important insights from an exchange standpoint. I was thinking maybe one more response from Oliver Gilvarry from the regulator standpoint. What do you think that could be done better?
Well, I think, thanks very much for having me on. I think one of the things, maybe a little bit of a positive, maybe, which is kind of unusual from a ministry, I think there was, when we compare to the great financial crisis, the interventions from central banks and from regulatory authorities and from governments was much greater and much quicker than what we saw in 2008 and 2009. And that, again, also flags that policymakers, we have learned lessons from the last crisis. I think maybe, there was criticisms as well, and, I wouldn't accept all of them towards the policymakers, that, clarity and transparency should have been given quicker. I think we should have, we all, both from a public sector and from a private sector perspective, we're dealing with unprecedented times, a huge amount of volatility, a very rapidly changing situation, remote working across the board. So it may have taken longer than what we would have liked to bring in some of the kind of the forbearance measures, whether that was on reporting or in relation to capital or information returns. And maybe that's something I think that we need to learn from, and I think we will, especially in an environment where all of a sudden overnight you're seeing maybe 80% of your workforce is suddenly just working remotely. So private sector weren't alone, that also in the public sector as well were impacted by that. So I think maybe to see how we actually can make the decision-making process via that remote access more efficient and streamlined, I think something both parties can learn from.
Thanks, Oliver. So sounds like we did okay, but definitely some opportunity for improvement to increase resilience and mitigate liquidity risk during challenging periods. So now I want to shift to our polling question results. How prepared is your organization for the next significant market shock? And can we share those results? So I don't know if we can go back to the results screen, but I think most people felt that they were, there they are. moderately prepared. So it feels like everyone as a whole in our audience feels relatively comfortable with how prepared they are to highly prepared, which is very good news because we are on the onset of potential liquidity challenges due to Brexit. And that could be the next event to cause a significant impact on market liquidity. So asking the panelists specifically to address the share trading obligation issues. And of course, the STO was also a topic in the recent consultation takeaways. So starting with Oliver Gilvarry, if there is a no deal or no equivalency arrangement, who within the ecosystem is most impacted? What liquidity related risk concern you the most? And lastly, what key mitigating steps do you think need to be done in order to prevent severe distraction and disruption in the markets?
I think the share trading obligation is something for us in Ireland that it's been an issue really over the last 2.5 years. And the structure of our market, the Irish market has very strong links into the UK market. The Dublin and London stock exchanges have dual listing. Over 80% of our stocks would be dual listed on both markets, and London has been a substantial pool of liquidity for our entities for capital raising and for growth. I think our view has been very much on the way the STO as it is currently structured is adding friction, potentially adding friction into capital raising for our companies. And that's not just only from an Irish perspective. And as I said, we have a significant interest in this. I think when we look across the board, especially in this time and as we're moving into the post-COVID-19 or into the recovery phase, one of the things that we have seen is that, European companies and companies globally, compared to the last crisis, haven't seen, even a 40, 50, 6% drop in revenues. They saw a collapse to zero. So we now are seeing our companies coming out of this crisis with much greater levels of debt than going in. So we do need a situation, this concept of re-equalization. So we see the STO as it is currently constructed, it's adding a friction into a time where we need to make it as easy as possible for European companies to raise capital, particularly equity capital. So I think, we are concerned about the way it is constructed. I think, at the best case scenario, if it continues with the way it is, I think we would see a drop off in transparency and a reduction in liquidity and increased cost of trading with the STO. All the issues that the STO was designed to prevent. It was, Ireland was involved in 2012. I was involved in negotiations in 2013 under the Irish presidency, and that was the objective of the share trading obligation. So we do have concerns that the objective of it, as it is currently constructed, will not be achieved. So we have been quite vocal in council on this as part of the capital markets reform package, and we have put forward proposals based on what was discussed in ESMA and was consulted on with industry, based on this emission to trading and Eisen concept. And we see that as a kind of a pragmatic approach to look at dealing with this issue, allowing companies to continue to access pools of liquidity outside the union in a time where it is key that they can actually raise that capital efficiently and cost effectively. So our concern really out of where it is at the moment that it results in dislocation in the market in early next year, or even really at the very best, the ultimate objectives of the share trading obligation, which we fully support, we will see a lack of transparency and an increased cost of trading in a number of areas, and something I don't think any of us really wish to see, both from an EU perspective or UK or other third countries. So I think we are still calling on the Commission and we are pushing in Council for a pragmatic approach and look to deal with this issue now as part of the quick fix that's there on the table. And we can always look again next year in a more detailed way to see what way it goes. But we do see emission to trading, and EU Eisen is a good way to look at this.
Thank you, Oliver. And I think it might be helpful also to have an exchange view on this question. So, Tom, could you add some comments to that?
Yeah, no, sure, thanks. And I think Oliver's comments there and his contribution to the ongoing debate are very constructive. Clearly, there's a concern about some disruption to liquidity, both in terms of capital raising, but also secondary market liquidity. And in order to be able to have us concern ourselves less about those sorts of unnatural disruptions and any cooperation that we can have, I think, in this time would be greatly beneficial. I mean, I think that at least the share trading obligation, as proposed from previously with a list of GB ISINs, has been refined, and there's constructive ongoing discussions, for example, with ESMA's proposal to allow domestic currency trading outside of Europe in EU ISINs. So I think these sorts of constructive contributions are very helpful. I think obviously what we see that the primary exchanges in Europe and elsewhere obviously have a significant concentration of liquidity, but it's the multilateral trading facilities that also contribute and complement much of the liquidity in the market. And so what we would expect to see, although to be carefully navigated, but venues such as Turquoise, creating Turquoise Europe, and SIBO Europe and Equities doing the same. For example, the block trading that is happening on Turquoise, if that was not available in the EU ISINs, because of the STO, that would be a great detriment to the investor return. And so we will likely see, as long as there is careful coordination to an extent of a liquidity shift, as Turquoise launches its Amsterdam, Netherlands regulated entity, we expect liquidity to almost seamlessly shift from the first day of Brexit, assuming no deal, to that European entity. But that would need, obviously, the community to do that. We can make available the instruments, but the community needs to navigate that by, for example, sounds simple, but it can be easily overlooked. Take the volume curve that they knew for trading an EU ISIN on a UK venue like Turquoise, to transfer that to create an artificial history for a venue that didn't previously exist, to make sure that the automated placement of liquidity remains a fairly seamless transition across those dates. So I think there's a risk of disruption, but I think with the right level of cooperation and pragmatism, as we were discussing, I think there will be hopefully a limited impact to the liquidity of the market at large.
Sorry, I was muted there. One quick final question. Thank you, Tom, for your comments. Tossing this one to Oliver Chapman. Are we ready if we do end up in a situation where we are no deal Brexit and we don't have a solution for this? How much lead time do we need as an industry to prepare to prevent disruption and to ensure orderliness?
I guess I could be quite punchy on this and actually say probably the 31st of December from a Barclays perspective. I guess, look, we've looked at all the different scenarios that can come out, and we've game planned for them. And ultimately, that then just leads to being able to understand which scenario has actually occurred, where we are, what STO regime has been put in place or interpretation of it, and then also whether or not there's even equivalence. We know it's the further down the negotiation piece of it, and it may not happen. So from that, it's very easy for us to be able to say, we can do it as a broker. We've game planned. We're going to move our clients over to our EU-facing entity if they're within the EU, and from there we can facilitate them if need be. So really, I guess I'd probably say that the ask from us as an industry, and I think this is probably echoes from the exchanges and to the other brokers, is as buy side, understand where your funds are based, where your PMs are based, what STO regimes you're going to need to have applied to you, and then just make sure that you can instruct us to trade those orders the way that you need to maintain compliance. Okay, and do a little fix protocol plug, and I think it's fix tag 8015, for instance, that you're going to need to use to be able to send it to us. We're here as your broker to be able to handle it, and I think that is going to be across the street.
Thank you. So one of the advantages of the delays in Brexit is that we've all been able to prepare, and the downside is that we've spent a lot of money and resources in preparing for multiple scenarios, but sounds like we feel that we're ready for this in case it happens. Let me move on to the last segment because unfortunately the time is going so quickly. We want to address some of the micro level liquidity impacting changes that are currently being debated and some of the recent regulatory consultations and reviews, and some of the developments in our industry model. So first of all, I want to throw out the polling question. Which topics would you most like to discuss in this final segment? And you'll have 3 options for that. So asking the audience to respond to that. And then while we're waiting for the audience responses, would like to talk about some good news. The European Commission has acted on concerns about the cost and administrative burden of a MiFID II regulatory mandate, which is quite exciting that they're thinking about these things. Séverine, could you briefly talk to us about the decision to suspend RTS 27 reports, please?
Yes, of course, thank you. I will not go into the details. You have the quick fix, MiFID II quick fix that is part of the CMU recovery package to hopefully being voted and accepted by the end of this year. And one of the proposals at the moment from the EU still discussed, obviously, is to suspend the RTS 27 best execution report, so not the whole of the best execution reports included into Article 27 of MiFID II, but only part of them. So not everything that is regarding RTS 28. I would say that is a surprising news, however, quite satisfactory. Well, as you can read from the responses to the consultation paper from ESMA, those reports are not very popular. I mean, there are many reasons for this. We obviously are producing ourselves those best execution reports, and there has been many problems that there are still. First, regarding the frequency and the publication, it's far too broad. I mean, when you look at some best execution reports being published up to 6 months after the trading day, this is too far away. We do not have any kind of harmonization on the EU level. There were lengthy discussions. I mean, within FIX, obviously, you had the fixed best execution group where we had to discuss absolutely everything, starting simply with the format of the reports and even what would be really a machine-readable format. Seems obvious, but actually it needed to be discussed. When it comes to all the statistics in the report, and we have many, actually, because of the lack of definition, really, we had to make a lot of assumptions regarding actually how you would interpret them to be in the spirit of the law. Not exactly what was written on the paper, but when you look at practically how to calculate, how to translate those statistics, what it would mean, what the regulators meant by putting down those statistics. So it is really, at the moment, I think it's impossible to work based on all the RTS 27 best execution reports published by venues. And I think it's probably a good decision to suspend those reports now. I would still say that I'm not saying they should be suspended permanently. I think the initial idea was a very good one, that it would support the investment firms into the definition of the best execution policy and also provide some of the market participants, probably retail investors, some information they could not get otherwise. So I think there's a revamp here, which would be highly welcome because I think there is some positive in those reports. But in case, or hopefully, that those reports will be reviewed with the MiFID II review, so by the end of 2021, beginning 2022. I'm hoping that we will have then discussions with the regulators because I really urge them to go for a more simple version of those reports, maybe 2 tables, 1 pre-trade, 1 post-trade, something that is published more frequently, but also that the content is discussed with the different participants in the industry. So the ones that are producing the data, the venues, but also the ones that are using the data. So potentially sell side by side and even retail, why not? But that we do not do it the other way around. We produce a massive reports, hoping that someone is going to use it, rather than looking at what which use is for these reports and then producing them keeping in mind what they are for. So I'm all for this kind of discussions with the regulators.
Absolutely. I think we agree, both from a micro standpoint, having a bit of a reprise on the RTS 27 reports, but then also from a bigger standpoint, looking at things from the perspective of the cost benefit. So thank you, Séverine. And now the results of our poll. Let's see what we're discussing. Okay, we have a three-way tie. So why don't we why don't we start with double volume caps proposed changes? So on the double volume cap proposed changes to remove or amend the venue and EU caps, Tom, in general, what approach do you think will deliver the best outcomes for the end investor? And specifically assessing this, who do you think will benefit the most from the proposed changes? Is it the investor, or are there other participants or stakeholders? And everyone should feel free to jump in if they have thoughts on this.
Sure. No, thanks. I'll just start. I think I think what we've been offered, I suppose, if you like, in the ESMA consultation is quite a limited change to the mechanism that had been introduced. So firstly, the removal of the 4% measure for single venue proportion of the total. I think there's likely to be widespread support for that to be removed to simplify the process. When it comes to 8% and any change to that, I think it's a little difficult at the moment to really have an objective discussion about it. The data that was used in the consultation paper was from January to September 2018, and here we are now, 2 years after that period, and it's quite difficult to know whether that data was representative of the real shift in liquidity in those early stages. So, for example, a lot of stocks were capped out in that early period, and whether that was therefore representative to use such a period close to the start of the the introduction. So, a move from 8% to 7% or another number, it's quite difficult to judge, I think, at this stage. One thing I think we can see is that there isn't perhaps the flip-flopping of instruments capped one period, uncapped, and then capped again. So I think the market has found a new equilibrium. Difficult to say that if you were to remove DVC altogether, whether that equilibrium now is at a level that is more stable and more supportive of the balance between price forming venues and trading using that price formation, which is obviously the definition really of the reference price waiver. But I certainly agree that we need to ensure the primacy of price formation, but we mustn't ignore the fact that actually there's a lot of demand for example, matching at midpoint, almost the fairest point in the market to match to natural buyers and sellers, and that any prevention of that, will effectively risk investor returns. So we would recognise the fact that there's been a growth in the large in scale volume in the market, which I think has been a great progress for the industry. The RPW itself, which is also for use for midpoint matching, and negotiated trading, I think that they've reached probably a new plateau. So whether you shift the 8 to 7%, again based on that limited data set, not sure it's going to make a huge difference. Probably better to leave it where it was and then continue to monitor more data, but perhaps consider lifting it. And will be interesting to see what happens if the UK and EU will start to diverge on their application of such a control, to see whether we find a test to that hypothesis of whether there's a new equilibrium to be found. So I'll stop there.
Thanks, Tom. Any other comments on double volume caps?
Dive in a little on that one and just kind of agree with Tom. I think we're tinkering around the edges a little bit, probably on that kind of 8 to 7%, and it would be great to be able to kind of give institutions, particularly the buy side, the choice on how and where they want to execute at what we consider probably a fair price, which is that midpoint matching. You know, at the end of the day, you've got to question where the self-serving nature comes from if we were to try and restrict that. You know, buy side have been very vocal around what they would like to do, and you know, the evidence has been there to support, you know, that midpoint matching. So let's use the empirical studies that people have put out there, and also, like me, I really did agree with what you're saying there, Tom. Let's actually see what happens if we do let the market find its own equilibrium, you know, with air to serve the end client, right? Which is that retail person sitting at the very end of the chain.
Yeah, as a provider of dark liquidity, we actually welcome these caps because I think it provided a proper response and a line in the sand to the big debate about price formation and whether you needed to actively limit dark trading to ensure that price formation was properly taking place on lit. We put these numbers in. I think they were always somewhat arbitrary. We welcome some simplification of that process. We welcome the structure itself because it provides that clarity. I think if we are going to make further changes to it, though, that should be probably more empirically based rather than, you know, what seems to be a somewhat arbitrary move from 8 to 7.
Thank you all. And we have just about 4 minutes left now. The time has gone so quickly. So I'd like to shift to systematic internalizers. Post-MiFID II implementation, Chris and Oliver, maybe you can address this for us. Have they evolved to play the intended role? And if not, where are the possibilities? And then also from the standpoint of the proposed changes to increase minimum quote size, does that help or hurt the intended role of our SI?
Oliver here. I might just kick off. I think with the SIs, you know, again, once MiFID II was agreed back in 2013, 2014, you know, the expectation was we would see a significant increase in them. I think it is timely for us to at least have a look. But, you know, our view is that do provide important liquidity into the market. I think where the ESMA consultation has come out on the standard market size, more than likely makes some sense. You know, we are in favour of increased transparency, so I think some adjustment there in the numbers. You know, I think ESMA are coming out with, you know, the increase to 100%. You know, it was consulted on between 50 and 100. But I think we do need to kind of realise they do provide important liquidity into the market. I would have more concerns with some of the changes that were being discussed on the more liquid instruments. I think making changes there to, you know, increase transparency or make changes to the SI structure for those, I think could have unintended consequences by, you know, driving out liquidity. And like, where would that liquidity go to, particularly on these, you know, less liquid instruments? So I think, you know, SIs and, you know, the structure of the SIs in the negotiations, and again in 2013, 2014, was to be a much more flexible product. Our framework compared to, you know, regulated markets or MTFs with certain restrictions. And okay, maybe we need to look at a couple of other bits and pieces, but I would be reluctant to make big changes. And it does touch as well on some of the points in double volume cap. And I think it is important that sometimes in these debates, the debates are on market structure. You know, do we drop from 8 to 7? Do we move from 10 to 50 to 100? You know, it will be important as we move forward into MiFID review next year that the end user has a strong voice and puts that forward. Because sometimes I do feel on this that it kind of gets on the infrastructure side and the trading infrastructure or the trading operation, it kind of gets, you know, about these numbers and, you know, are they arbitrary or not, and what's the data? I think we need to hear a lot from the end users. And it is something I would say to you, you know, for you operating venues, is to kind of get your end users to go out there and get their voice out there to show, well, like, we like the SI structure, we think this maybe should be changed, or, you know, double volume cap we think works well. We do believe a consolidated safe trading in place. Is to get that message out there, because we as policymakers, we want to hear that. I do feel sometimes the end user is somewhat forgotten in some of these debates, and it's kind of late in the day that it suddenly goes, oh, this is going to cause a problem, and then you're rushing around trying to fix it.
Thanks, Oliver. And Chris, quick 30-second last word on that.
Sure. So we don't operate an SI, but we do watch this space very carefully for our clients. A couple of comments. I think market capital provision in the market is and has always been a function of volatility, spread, and counterpart type. I think it is a fact that it is becoming increasingly automated as margins are being compressed in that space, and that's primarily a function of spread compression. I think that as we, some of the regulations to perhaps try and create greater size at the touch are going to be hampered by the fact that the rewards for capital commitment in that kind of size are simply not there, and there is no magic potion to this. So I think we have to recognize that relationship between spread and size. If we want larger size on a capital provision basis, then it will have to be recognizing that that's going to be at some point outside the current touch. But look, we welcome any kind of innovation. I think SIs are an important part of the liquidity franchise that we look at.
Thank you, Chris. And that's our time. Thank you sincerely to the panelists for an information-packed discussion. It was truly my pleasure to share the virtual stage, and thank you to the virtual audience for your engagement and participation. Thank you so much. Enjoy the rest of the conference.
Thank you very much, panelists. That was extremely insightful. And I think the two sort of key themes that have come out from there that we noticed in this studio was essentially the positive outcome from the markets, just in terms of not only the technology holding up, but actually that things worked in the way that they should. Unfortunately, we had a couple of technical issues our end, which have now been resolved. So for those of you who are watching, we apologise for that. The full interview will be available online afterwards if there are any bits that you missed. But I think the other point that came out loud and clear is just how we're only one step, and exactly on the same with the buy-side panel that we had. The lessons that we've learned from post-COVID as one side, but actually it's what's yet still to come, particularly in relation to the share trading obligation and potential implications for Brexit. So once again, thank you very much for joining us. Thank you for your time, and thank you to everyone who was watching and listening. So we've got another 15-minute break, and then we will be back and moving on to technology and automation in fixed income, and that panel will be led by Matt Coop. Thank you very much indeed.